Okay, everyone. This is supposed to be a walkthrough for our team because we were going through a currency trading school, and the school is great, but where they start with everything starts with people. It seems like it assumes that people have some basic understanding of what currency markets even are, how they're traded, all of these things. And so before going through that, for anyone who joins our team, I put this together because it explains some fundamental concepts that they skipped. And so we'll jump in and we'll try and do this in under 5 minutes. So the first thing on the screen is just the components of a chart. You look at these things and it just looks like a bunch of red and green and ups and downs, and you don't really know what you're looking at. And so the first thing that we want to understand is on the left-hand side, all the ups and downs are showing you the ups and downs in prices. So that's pretty good to know. And then the left shows you older times, and it goes to the right that shows you the newest time on the trading scale. And so that time frame is important because you can also adjust the charts to show you, okay, what did it do for 5 minutes, an hour, a day, a month, 6 months, a year. You can adjust the charts to see how the prices changed over different time frames. So after that, what you see on the charts are all of these little red and green bars. And another fundamental concept that wasn't explained is that these red and green bars are called candlesticks. And these charts are called candlestick charts. And it's important to understand the components of the candlestick charts and understand how the candlesticks themselves work. So the green candlesticks show when price is increasing over a period of time. And the red candlesticks show when price is decreasing over a period of time. And what we should know is that the components of a candlestick are what you use, and the collection of candlesticks are what you use to decide what you want to buy, when you want to buy it, and why you want to buy it. And so what you'll see is on the chart with a green candlestick, your time period is where it opens. So you see here, open. So if it's a 1 hour chart, then this is where it started at the beginning of the hour. Close is where it starts where it stopped at the end of the hour. So the candlestick just represents that time frame of where it opened and closed. But in terms of price, so it opened at one price and it closed at a higher price is what happens with an increasing or bullish candlestick. But during that 1 hour, the price can do lots of things. It may go lower. The price may go lower than where it was when it opened. The price may even jump higher to where it was when it closed. But you'll see these candlestick, candles have wicks. So these candlestick wicks here in the middle will show you exactly how high the price got during the hour, how low it got during the hour. I'm using hour as an example, but during the time period. And then you see exactly where it opened and closed here. But the green indicates that this is an increasing, again, or bullish candlestick. Now, on the other side, what if the price dropped during the hour? Then that's when you see a red candlestick, and the red candlestick symbolizes that it opened at one price and it closed at a lower price. That doesn't mean that these are the only prices that happened during that time period. Again, the wick shows you how high the price got during that hour or that time period, and how low the price got during that time period. And these are considered bearish candlesticks or a decreasing candlestick. So that's what the market is made of, all of these candlesticks. So what we're looking for in terms of actually wanting to trade something is we're looking for a collection of candlesticks that are repeating patterns. And for example, when you look at a chart, you may see there are three different kinds of charts. There's an uptrending chart, a sideways chart, and a downtrending chart. So with an uptrending chart, what you'll see is that over the time frame, again, across the bottom, we have the time frame, we're seeing our price start at one level and then go high. And it may be confusing because you're seeing a bunch of, zigzags, but what you'll know from an uptrending chart is that when the price goes low, it is a higher low than this point. So this is our low, and then it went high. As long as this price doesn't drop down to this level or below, this is now a higher low than you had before. And then it goes up again, and now you have a higher high than you had here. So this is higher than this. And then there's a higher low and a higher high. So an uptrending market chart looks like higher highs and higher lows over whatever the time period you're looking at. So you'll see it like this. So this represents a bunch of candlesticks, but you'll see if you trace the pattern, you have an uptrending line. And if you see an uptrending line, you can make your buying or selling decisions based on that. On the other side, you have a downtrending market. And with a downtrending market, your price starts at one point and then it drops down. And then it may go up again, but it's a lower high. This is our new high, but it's lower than our previous high. And then it drops, and then there's another lower high, lower low. So that's what you'll see on a downtrending market. And there are terms in here in terms of this is considered an impulsive move where lots of buyers and sellers are moving in one direction. And this is considered a correction to the market. And you can think of, if you do something impulsive, you might go, oh, that was impulsive, and you'll try and adjust or correct for what you did. And that's essentially what the market is doing. But again, with a downward trend or a bearish market, you'll see this progression. And there's a third market where you see there are no new highs or lows or anything. They're just kind of side by side. You see this pattern, and that is a sideways market, or I think it's also called a round market or a flat market. And that tells you that you're not experiencing any new higher highs or lower lows, and you're not experiencing any new lower highs or lower lows. You're just you're just in a sideways market. So these are some of the fundamental concepts that they skipped in our training, and they're really fundamental because what's happening is once you even understand what a chart is, what a candlestick is, and how to recognize the upward trends, the downward trends, and the sideways trends, you can then hone in and see that even within a bullish or uptrend pattern, there are different types of signals that you can look for. And then again, with a bearish pattern, there are also certain things that you can look for that can tell you, that can indicate for you, okay, this is where I want to buy or sell because I've now recognized these patterns. So I'm not strong enough to even get into the patterns. I haven't memorized them myself, but you now at least have the framework to say, okay, now that I understand fundamentally what is even happening on a chart, from there, I can do more study and investigation on how to trade.